Northwest investors.
A tough start to the week on Wall Street as the slide in tech stocks continues on earnings worries. The Dow tumbles 88 points and the tech-heavy NASDAQ drops 20 points.
Pfizer's new CEO unveiled his prescription for growth today, but the plan's 10,000 job cuts are a bitter pill for Pfizer employees.
Boeing shares get caught in a downdraft. The jet maker's stock slides on a brokerage downgrade. We'll tell you what's behind that move.
Then the White House is promising bold action on health care in the president's State of the Union address. We look at President Bush's controversial plan to make health insurance more accessible.
I'm Paul Kangas.
And I'm Susie Garoff. This is Nightly Business Report for Monday, January 22nd.
Nightly Business Report is made possible by...
Is your nest egg in shape for retirement? Objective financial advice can help. A.G. Edwards, for more than 118 years, fully invested in our clients.
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments, gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. A painful dose of medicine today from the world's largest pharmaceutical company. Pfizer said it'll cut 10,000 jobs and close plants and R&D sites over the next year. Speaking at an investor conference in New York, Pfizer's new CEO, Jeffrey Kindler, says the new strategy is designed to cut costs and combat declining revenue from top-selling drugs that have lost or will soon lose patent protection. Suzanne Pratt details Pfizer's plan and gets reaction from Wall Street.
Pfizer did its best to soothe its restless shareholders today, pledging to cut annual costs by as much as $2 billion next year. Pfizer CEO Jeff Kindler, on the job only about 6 months, outlined his new vision for the troubled drug maker at an analyst meeting in New York. He said there were no longer any sacred cows at Pfizer and that the company would transform itself.
We must become more efficient, more nimble, and more responsive to our customers and our environment. In short, we must change the way we do business so that we can tackle our most daunting challenges and seize our most promising opportunities.
Pfizer plans to meet its cost-cutting goals by slashing 10,000 jobs or 10% of its global workforce by the end of next year. Many of the positions will come from middle management. The company also plans to close plants in Brooklyn and Omaha and sell another in Germany. In addition, it wants to shutter 5 R&D sites. Kindler says he realizes Pfizer can't simply cost-cut its way to success, but some analysts are worried that's exactly what the company is trying to do. Still, Lehman Brothers analyst Tony Butler, who owns Pfizer stock and whose firm does business with Pfizer, applauded today's news.
I think that they took a major step forward. I am not aware of an organization in the pharmaceutical arena which actually had an overall reduction in absolute costs.
Pfizer's fourth quarter earnings, also out today, underscore the company's difficulties. Profits slipped 12% in the quarter on flat sales, in part because of the patent expiration of top seller Zoloft. Making matters worse, in 2010, Pfizer will be faced with generic competition for Lipitor, which generated annual sales of $12 billion in 2005. It's no wonder that Pfizer shares have been under pressure and are trading only a few points above their 5-year low. Analyst Joe Tooley of A.G. Edwards, which has done business with Pfizer in the last year, maintains a hold on the stock.
While top-line revenues should remain flat for 2007, 2008, it isn't until 2009 we start to see some growth, and then in 2010 you have Lipitor going generic. So they have significant patent exposure concerns. And so in light of that, it's tough for us to get excited about the name.
In order to boost revenue, Pfizer is expected to shift into a modest acquisition mode. Analysts say Pfizer will be looking for new licenses, partnerships, and deals with companies that already have products ready for market. Suzanne Pratt, Nightly Business Report, New York.
Sellers took command on Wall Street this morning as last week's tech stock sell-off continued, while a rise in oil prices was another negative. Brokerage downgrades on Boeing and Cisco stocks also brought the bears out. By noon, the Dow was down 105 points and the NASDAQ off 25. This afternoon, oil lost ground, which helped stocks trim their losses, but the market still ended broadly lower on balance. The Dow Jones Industrial Average closed down 88.37 at 12,477.16. The NASDAQ Composite fell 20.24, ending at 2431.07. Standard & Poor's 500 index dropped 7.55 to 1422.95. Over in the bond market, the 10-year note gained 5/30 seconds to 98 and 30 seconds, putting the yield at 4.76%.
Our guest tonight says the markets have not had a serious correction for 1,100 days, and 2007 could be the year it happens. Joining us now to explain, Alan Skranka, Chief Market Strategist with Edward Jones. Hi, Alan.
Hi, Susie.
So are we in the beginning of a corrective phase?
Well, no one can say that for sure because you can't time market corrections, Susie. I do think it's important for investors to understand, though, that we've had some awfully good news for a long time. This market has really rallied going all the way back to 2003 without a 10% correction. And now we're seeing only the second time since the end of 2002 that earnings are coming in below what the analysts were looking for.
But we had so much momentum in the markets, especially at the end of 2006. What's really changed here?
Well, I think what's changed has been the earnings environment. We've had 18 consecutive quarters of double-digit growth in operating earnings for the companies in the S&P. That's a remarkable, unprecedented string. We've had 14 of the past 15 quarters where those earnings have beat analyst estimates. And the analysts were estimating 13% growth for the fourth quarter earnings, and they're coming in closer to 6 to 7%. That's a big disappointment.
There are a number of Dow components that are going to be reporting this week and next week. Tomorrow we have Johnson & Johnson and DuPont, and then McDonald's on Wednesday, AT&T and Caterpillar. Do you think that we are going to get a different message from this batch of earnings?
Well, I think it's going to be a mixed bag. You also had Texas Instruments after the close that looked like an apparent miss. So we're seeing the biggest weakness in the technology sector, where double-digit growth expectations are now 0% growth expectations, and also in energy, where we're looking for a double-digit decline.
Let's talk a little bit about the tech stocks, because last week we had some disappointments, even though the earnings came out relatively well from whether it was IBM or Apple or Intel. Investors were not happy with those earnings. What is the outlook for technology stocks?
Well, I think it's very mixed. Technology investors are famous for having expectations that are just too high. Look what happened the last few days in Apple Computer, for example. And when those expectations are not met, the stocks come down pretty significantly. So it's important to have balance and not to have too many of your eggs in the technology basket.
We saw that the NASDAQ Composite Index had some good momentum also near the end of last year. What is your outlook for the NASDAQ for 2007?
I would say it's very cautious. That's not where I would be putting money right now. I would be looking to become a little bit more defensive, a little bit more cautious. But again, make sure you have good balance because the mood on Wall Street can change very quickly.
Let's get some of your top recommendations for 2007. I know it's always hard to generalize, but for an investor who's looking for long-term investments, what would be your top, let's say, 2 stocks?
Well, and that's our focus, is long-term investments. We like companies that are very well managed, that pay good dividends. We like the large caps versus the small caps. So Procter & Gamble, 3M are very well managed companies that we think are attractively priced and poised for good growth.
I know that you have an allocation for a standard portfolio in your firm of 65% stocks and 35% bonds. Any advice for long-term investors on how to navigate through this market for 2007?
Well, it's really to pick an appropriate asset allocation that's right for your goals and your risk tolerance, and don't vary it. As I said, the mood on Wall Street can change very quickly. We're off to a little bit of a rough start this year, but over the long term, stocks still should outpace bonds, and so invest accordingly.
Alan, before we wrap up, can you tell us your disclosures on the two stocks you recommended, 3M and P&G?
Yes, I don't own the stocks, and we don't do investment banking for those companies.
Thank you so much, Alan. Great having you as a guest
Sure.
this evening. We've been speaking with Alan Skranka, Chief Market Strategist with Edward Jones.
On the eve of tomorrow night's State of the Union address, Democrats say President Bush's latest initiative to expand health care coverage would make a bad problem worse. The plan would cap the deductibility of employer-provided insurance plans and use the tax savings to expand health care coverage for the poor. Darren Gersh reports.
For decades, healthcare analysts have complained the tax code heaps benefits on workers with relatively generous employer-provided insurance and punishes those who buy it on their own. Analyst Joe Anto says the president's latest plan could level the field.
This is a Republican president saying that high-income people should pay more for their health benefits, should pay a little bit more for the health benefits through the tax system, and that money should be redistributed to low income.
The president wants to provide a standard deduction for health insurance, like the one for children and other dependents. The White House says that would save an average family buying health insurance on its own more than $3,600. Employer-provided health insurance benefits above $15,000 for families and $7,500 for singles would be taxable. That means 1 in 5 workers with what the president calls gold-plated insurance would end up paying more in taxes. White House Press Secretary Tony Snow says the goal is to give more people access to health care.
That is a proposal that is really bold and offers an opportunity to open up the healthcare system in a way that it's never had before.
Analysts say the high-profile rollout of the administration's plan is a sign of growing momentum across the country to cover the uninsured. And if that trend continues, health insurance companies might face more competition, but also see an increase in revenue as more people get coverage. Goldman Sachs Washington analyst Alec Phillips says the biggest winners would be those on the front lines of medicine.
Hospitals come out on top of almost any proposal because they are the ones who are paying currently for the care being provided to those who lack insurance. They provide the care, and yet nobody's paying them to do it.
Democrats called the president's plan bad policy, arguing it would raise taxes on many middle-class workers and reduce incentives for employers to offer health insurance. But the White House clearly hopes this plan will at least jumpstart negotiations on free market solutions for expanding health care coverage. Darren Gersh, Nightly Business Report, Washington.
Corporate America is also calling for negotiations on the issue of climate change. Chief executives of some of the nation's biggest companies said today they want President Bush to support mandatory reductions in greenhouse gas emissions. The group includes General Electric, Duke Energy, and Lehman Brothers, among others. It's also calling on Congress to create a policy framework for a mandatory market-driven approach to climate change. Jim Rogers of Duke Energy says businesses have the technology and innovation to compete successfully in a carbon-constrained world.
We need a program flexible enough to cope with the economic and technical challenges ahead, but it must be mandatory. So there is no doubt about our commitment to concrete action.
Have announced several proposals to address climate change. Business executives stressed today that they want to have a seat at that table to help shape what policy proposals are put in place.
Sun Microsystems will soon be saying it's Intel inside. The server maker today ended its exclusive use of chips made by Intel's chief rival, Advanced Micro Devices. Sun Micro has agreed to use Intel's Xeon chips in its servers, and in exchange, Intel will endorse Sun's Solaris operating system. While analysts say the deal won't be a big revenue generator for Intel, they do call it a big blow to rival chip maker AMD. Sun Micro CEO Jonathan Schwartz and Intel Chief Executive Paul Otellini say today's move is more than just a chip sales announcement.
The single biggest shift as a result of this relationship is the fact that Intel has endorsed Solaris, which really does, make it quite definitive that the 3 volume operating systems out there are going to be Windows, Linux, and Solaris. And so the fact that Intel and Sun are working together on the evolution and the adoption of Solaris does change the game. It's fairly dramatic for us.
In this case, I think that as Intel's software team gets to put his hands around Solaris and be able to help optimize the performance of Solaris for our hardware, our chips, that really is a good thing for everyone involved. It's good for Intel, it's good for Sun, it's good for our customers.
Sun Micro has just emerged from a major restructuring. Schwartz says today's deal with Intel grew out of that restructuring, which focused on improving server sales and boosting the profile of Sun's Solaris operating system.
One of the most powerful women on Wall Street has a new job tonight, and it's her old job. Citigroup's Chief Financial Officer, Sallie Krawcheck, is taking over the reins of the company's wealth management division. The move returns her to an assignment she left in 2004 when she swapped jobs with then CFO Todd Thompson, who resigned today. Krawcheck won't formally take the new posting until Citi finds a new CFO. She said today she's enjoyed overseeing the huge bank's finances, and she's looking forward to returning to an operating role. But investors have been pushing Citigroup to make changes in its management, Paul, due to its sluggish stock price.
Citi's stock price got a boost today on that news, Susie, and we'll see it as we look at our stocks in the news tonight. Most active New York exchange issue today on 20.8 million shares. Motorola down 55 cents, still under pressure from concern about the company's profit margins. Then came Pfizer down 27 cents, slightly negative reaction to the company's restructuring you just heard about. Ford Motor up 11 cents, GE a 20-cent drop, and Sprint Nextel gained 7 cents, fifth in volume. Then we see ExxonMobil down 63 cents as oil prices faded toward the end of the day. EMC down 12 cents. Citigroup edged up 18 cents. You just heard about the management change there. J.P. Morgan Chase was up 90 cents. But just as the market was closing, the company announced a dispute with software company Actuate, which could disrupt many customers' access to their banking statements. AT&T, 10th in volume, showed no change, although Merrill Lynch upgraded it from neutral to buy and boosted its 2007 earnings estimate by a nickel to $2.65 a share. Boeing was down $3.03. That hurt the Dow by over 20 points. Wachovia Securities downgraded the jet makers from outperform to market perform in the belief the commercial aircraft orders cycle has peaked out. Then came American Express with a loss of just 3 cents, not much of a reaction. Fourth quarter earnings 76 cents, up from 60 last year. That was just in line with estimates. Eaton Corp down $3.85 despite fourth quarter earnings rising to $1.59 from $1.38 last year. That's what the street expected, but the company said 2007 revenue growth will be flat. That's what hurt the stock, I believe. The company did boost its dividend quarterly by 10%, however, to 39 cents a share, and it's going to buy back up to 10 million shares. A.O. Smith, which makes electric motors and water heating equipment, had fourth quarter earnings up 18% to 61 cents versus 52 a year ago, and sales up a very enviable 25%. Cooper Companies, which makes healthcare products, plans a $1 billion financing, and analysts say that could cause some earnings dilution. Stock down on that news. Under Armour down $3.99. This week's Barron Financial notes that this hot apparel maker stock may be in for a kind of a cool down, at least according to some analysts. Johnson Controls moved up $2.72. Bank America boosted its price target from $91 to $110 a share, a big boost. And this is the national telephone company of Venezuela. The Venezuelan President Chavez said yesterday that his government will not pay market price in its move to nationalize this company. Not exactly a surprise, apparently. Apple Computer down $1.71, then Google losing nearly $9. Cisco off 17 cents. JMP Securities downgraded Cisco from outperform to market perform. Microsoft 39-cent loss. Amgen moved up $1.60. There's optimism the company may win a patent dispute that it's having with Roche Holdings. Intel, 3-cent loss there. Research in Motion down $3.15. Oracle down 27 cents. Qualcomm fell 36 cents. And Dell, 10th in volume, was down 53 cents after UBS cut fourth quarter earnings estimates from 30 down to 28 cents a share. Swift Transportation did well, up $2.52. The founder, Jerry Moyes, and his family members have sweetened their buyout bid from $29 to $31.55 a share. The company has accepted the bid. Over in the American exchange, look at that percentage move. Analex, a British defense contractor by the name of Kinetic with a strange spelling, is going to acquire it for $3.70 a share in cash. Those are the stocks in the news tonight. Susie?
Paul, a new report shows New York City could lose its status as the financial capital of the world in as few as 10 years. Mayor Mike Bloomberg and U.S. Senator Chuck Schumer commissioned the study showing New York and other U.S. cities losing ground in financial services, while cities like London, Dubai, and Hong Kong push ahead. The report cites 3 key reasons why New York City could lose out on billions of dollars in financial services income. First, the costly post-Sarbanes-Oxley regulatory environment. Second, the impact of immigration policy on attracting qualified workers. And finally, the United States' expensive legal environment where other countries discourage frivolous lawsuits. Both Bloomberg and Schumer are calling for reform of Sarbanes-Oxley and the creation of an international financial services zone.
Tomorrow, an unexpected take on the growing popularity of video games.
Here's a look at what's happening tomorrow. As we mentioned, President Bush gives his State of the Union address. Also tomorrow, a host of earnings, including Advanced Micro Devices, Bank of America, Coach, DuPont, UAL, United Technologies, Xerox, and Yahoo. Tonight's commentator says it's high time for a grand bargain between business and labor. Here's Alan Blinder, partner in the Promontory Financial Group and former vice chair of the Federal Reserve.
In a recent speech that got too little attention, Congressman Barney Frank, the new chairman of the House Banking Committee, proposed what he called a grand bargain between business and labor. Well, it's really a grand bargain between congressional Republicans and congressional Democrats, but never mind that. The point is that it's a good idea. Frank's idea is simple but bold. There are a number of policies that labor wants badly, but that business finds abhorrent, like universal health insurance, a friendlier climate for unions, and fewer trade agreements. On the other hand, there's a different set of policies, including less regulation, a sensible immigration policy, and more trade agreements that business desires, but labor often blocks. In the current political status quo, Democrats dig in to block businesses' priorities, while Republicans dig in to block labor's, and so nothing gets done. Things would be better off if we could give both sides a little bit more of what they want. Hence Frank's idea, and it's a good one. As Monty Hall used to say, let's make a deal. Mr. Frank says that he'll support some deregulation, a rational immigration policy, and more trade agreements, if the trade agreements have reasonable labor and environmental safeguards, and if Republicans will support universal health care and stop blocking union organizing activities. That all sounds good to me. Now, if only Congress would follow Monty Hall's good advice. I'm Alan Blinder.
Recapping today's market action, it was downhill right from the open. By the closing bell, the Dow had lost 88 points and the NASDAQ had fallen 20 points. To learn more about the stories in tonight's broadcast, go to Nightly Business Report on pbs.org. You can also email us at nbr@pbs.org.
And finally tonight, it took British and Canadian explorers 7 weeks and more than 1,000 miles of trekking through the Antarctic. But on Friday, they became the first people to reach the most remote spot on Earth without any mechanical help. The explorers braved howling winds and sub-zero temperatures on foot to get to what's called the Pole of Inaccessibility. That's the place on the planet farthest from any ocean, and it's 12,000 feet above sea level. So imagine their surprise when they found a souvenir sticking out of the snow from the last people to get to the spot. It was a statue of Vladimir Lenin. Apparently, Paul, it was left there in 1958 when Soviet explorers used snowmobiles to travel through all that snow and ice.
No doubt a chilling discovery and an ironic one, too, to have a Marxist mark the spot.
That's Nightly Business Report for Monday, January 22nd. I'm Susie Garib. Good night, everyone. Good night to you, Paul.
Good night, Susie. I'm Paul Kangas, wishing all of you the best of